Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Ben Poole, Writer at CTMfile. Welcome to this episode of the Open Treasury podcast, Paul and Ben.
Thank you, Push.
Hey, Push. Thanks. Appreciate it.
A big thank you to you both for taking the time to share your perspective with us on topics that impact the world of corporate cash and treasury management. Let's delve deeper and get your thoughts on our topics for today, namely China's digital payments dominance and digital yuan likely to fuel global AI supremacy. ECB pits PayPal's stablecoin as new bogeyman in CBDC race. JPMorgan chief attacks stricter capital rules proposed by US regulators. And finally, EU Commission reduces its eurozone economic growth forecast as Germany enters recession. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's start today's discussion, gentlemen, with our first story for today, which is about China's digital payments revolution and digital yuan that is likely to fuel global AI supremacy. In China, digital payments, not cash, is king. This is one of the few bright spots in the world's second largest but stuttering economy, weighed down by deflation, a sliding yuan, record youth unemployment, and a real estate crisis. Home to the world's biggest e-commerce market, China has taken the spotlight in the global digital payments arena by leapfrogging from cash and magnetic stripe credit cards and debit cards to a digital payment system based on smartphones and scannable QR codes. According to the World Bank's Global Fintechs Database 2021 report, a striking 82% of Chinese adults made a digital merchant payment in the same year. That figure is more than double the global average and serves as a powerful reminder of China's dominant position as a world leader in digital payments. Looking ahead, the national and international rollout of China's central bank digital currency, the digital yuan, is expected to reshape the way global corporations think about cash and liquidity management, as well as wholesale cross-border payments. Paul, given that digital payments and AI or artificial intelligence are taking center stage within corporate treasury, how do you envision China's digital payments landscape and its aim to establish itself as a global AI leader influence multinational corporations and their treasury departments' decision making?
Yeah, Push, I've been talking about this on several podcasts before about China's adoption rate for digital payments or digital currency, their acceptance of this idea that the central bank will digitize their currency, as something that people need to pay attention to. It's pushing other more developed countries to really think about what they're doing for digital currencies in their home countries. Payments, the way we pay for things, is changing globally. There are clear signs based on this article and the research that's out there that shows that acceptance in Asia is outpacing, Europe and America. I think that will continue to be the case in the near term. I think we'll see at some point that there'll be a tipping. We see in the article that talk about European-based digital currency for the euro. I think that is, taking some steps forward. I know here in the U.S., we're also considering a central bank digital coin as well. So it's kind of steps to get to the endpoint. Now, China gets there before everybody else. That doesn't necessarily mean they'll be the leader per se. They'll be the leader in the sense that they'll have that currency out there. It will get certainly tons of acceptance there in the Asian arena. The question will it be acceptable for payment of goods and services outside of China? I think that is not as clear to me today. That may be a little bit slower pace for adoption, but it doesn't mean that it won't be. I just think the way that everything's going globally is towards digital payments. This article does a great job of laying out, how China got to where they were, the rapid growth in the economy, the acceptance of e-commerce, the ability to utilize platforms that were built within the country to make payments, and their concept and their idea of it doesn't have to be the bank. The bank may be, in some cases, not even there at the table. So we're talking about this idea of non-bank financials, companies that are able to provide the railway, the pathway to make payments. Obviously there's got to be security around that. There has to be protocols in place to ensure that the payments make it to where they need to be. But just the fact that they have these various companies within their country that are basically building out, constructing these pathways, and it's being allowed to happen, shows that China really has flexibility to think outside the box and take some risks to create these new payment rails. And I think it's a good litmus test for countries outside of China to take a look at what they're doing, because what they're doing in some of these cases is good. The question is can it be replicated outside of China? Will adoption rates happen at a rate that is comparable to what we're seeing there? Perhaps not. We're not seeing evidence of that right now, but we're hearing more chatter around the build out of a central bank digital coin. So I think that's going to pick up some steam, especially if China's getting to the finish line ahead of everyone else. I think that's going to pull other countries into this arena. And I think we'll see a faster pace of adoption outside of China.
Yeah, I completely agree with those points. And something that jumped out to me in your article, Push, which is excellent and full of great details around like the all the different factors that are combining in China to really put them over the top with digital payments, was the participation in Project Enbridge. We're looking at CBDCs as sort of maybe the next major shift in payments that are getting there. They're coming down the pipeline. They're not here yet, but apart from in a couple of smaller territories, but I think we're all expecting them to start maybe ramping up at some point in the next few years. So it's just looking at how these array of CBDCs connect globally, how they flow cross-border. There's plenty of issues to be solved there as everyone internally is building their own national coin. Mm-hmm. You can't be very successful if there's not suddenly the international flow of money is called into question. So Enbridge is one of a few multi-CBDC projects that are going on today. So China's participation in that is worthy of attention alone. And, if China does want global digital payments preeminence, not just in the size of what it's doing within China, but also in terms of influencing the rest of the world, then, if they're potentially solving global CBDC infrastructure questions as part of that, I think that's very interesting. So that's certainly something that caught my eye in the report.
Yeah, the other thing that I note out of this article is India is leading real-time payments. I think what's kind of important about that piece with the real-time payments is that I can see central bank digital currency going hand in hand with real-time payments, and that those kind of collapse together and almost in partnership when you think about the railway, but the currency to effectuate those transactions and real-time payments. So I think China is behind both India and Brazil in the case of what we see in this article. So I do think real-time payments is also something you can't ignore. Here in the U.S., we have FedNow, which allows all these local small banks in the U.S. to participate in real-time payments. From, that type of infrastructure, when I think back at, towards the U.S., we're in the race on one part, and the other part, central bank digital currency, we're still working through that piece. So, I think we still got some more work to do here locally in the U.S. Europe is also working on it. I think we're going to see other countries around the globe that are going to start stepping up participation in these two areas where I think demand by not only just people for goods and services, but corporations as well. So I think it's going to transcend from retail to corporate.
Those are great insights. And, what both of you mentioned, particularly about real-time payments, Paul, and Ben, you mentioned Enbridge. I think those are important and discerning insights from, your conversation. I hope our audience is paying attention to that. Let's move forward to our next story, wherein ECB pits PayPal's stablecoin as the new bogeyman in central bank digital currency or CBDC race. In a speech to the Committee on Economic and Monetary Affairs of the European Parliament this week, Fabio Panetta, member of the Executive Board of the European Central Bank or ECB, put forward the case for the digital euro and highlighted PayPal's launch of a stablecoin last month as yet another reason for a European CBDC. PayPal announced the launch of its PayPal USD stablecoin in August, stating that it is designed to contribute to the opportunities stablecoins offer for payments and is 100% backed by US dollar deposits, short-term US treasuries, and similar cash equivalents. Ben, to my mind, this is an important story, and you covered this for CTMfile. European Central Bank's Fabio Panetta has warned of the risks associated with private stablecoins while making the case for a European CBDC. Do you concur with the problems he has outlined with a privately backed digital currency and think that a European CBDC is a better alternative?
Thanks, Push. Yeah, I think the argument he's making is all around, I suppose, financial stability and what the central banks and the ECB, specifically in this case, bring to the world of payments and money today, and the threat that they might not be able to do that tomorrow if they don't act. So he was saying that, it preserves the role of public money and would offer a social equity element that can't exist in the private sector. So I think it was basically just a catalyst. He was trying to drop a grenade in the parliament and just try and chivvy people along about the inherent dangers of waiting too long to implement a digital euro. Because like you say, PayPal, and there are others that have kind of come out. They've got stable coins. They're finding ways to translate between fiat currencies to digital currencies and back again. So kind of negating a little bit the role that the central bank would play. So I think there is value to the argument that he's making. Central banks are the custodians of the current global financial system. So inaction on something as important as digital currencies, which we talk about a lot, it's a big trend in financial services, could see them lose ground to these private providers of such services. And of course, his comments are very much from a European perspective. We've already discussed on the call today that CBDCs are perhaps further along in China and indeed in many other places in the world. So perhaps the danger in Europe is that the digital euro might not only be lagging behind the private digital coins, but also other CBDCs, and maybe the prowess of the euro as, one of the top 2 or 3 global currencies could come under threat if they don't accept maybe the new parameters that we're going to be operating in. And you need to be working on those and getting those ready now, not waiting for, a digital yuan or, a digital dollar or whatever to come along and then go, okay, well, now we can go. They need to be more proactive. So it's an interesting argument, and it's certainly one. I'm sure PayPal won't mind their name being mentioned quite a lot because it's kind of highlighting that they're already there and doing it.
Yeah, Ben, when I read this article, it just really hit the nail on the head for me because I've been thinking about this for, quite some time. It's like, there is a demand out there in the market, especially within the U.S., for a digital currency of some kind tied to the U.S. dollar. Its central bank's not going to provide it. Non-bank financials like a PayPal that has a payment rail in place is going to do it. So PayPal's not the only one out there. I think we've seen a significant rise in U.S. dollar denominated stablecoins in the past 12 months here in the U.S. This step forward by PayPal, it really makes sense. So it's, hey, central bank, fine, you can continue to do the work that you're doing to ensure that your central bank digital coin is going to have all the aspects that you want, the controls, the safety, the security, the right payment rail, so forth and so on. However, in the market's going to tell you exactly what is in demand. And the reality is that U.S. dollar denominated stable coins are in demand. So if you're not going to create it, somebody else is for you. And that's what they're doing. I know I've got somebody, here I know locally that started a company about 12 months ago, maybe a little less than that. And they introduced earlier this year a U.S. dollar-based stablecoin. They're a relatively small company that's going to grow, I think, by quite a bit because there's demand for this. And it's not just consumers, it's corporations as well. So treasurers are thinking about this as well. The acceptance of Bitcoin or other type of tokenized currency out there, or stable coins in this instance, that's something that I think treasurers are going to take note of, and they're going to put in capabilities to accept and transact utilizing these stable coins that are available out there, whether it's US based or Euro based or otherwise. I think we're going to see more and more of this happening. The article that we talked about earlier about China's already been doing this. They're using our platforms and they're doing this kind of thing. So why not here in the US? This is a logical step forward. The market's saying it wants it, needs it. You can't ignore it anymore.
Absolutely. As you say, the demand is growing. Consumers, when they go online to make purchases, they might want to use these coins. So as a treasurer, you've got to think, are we enabling that on our site? Is that one of the payment channels that we're accepting? And if we do, how are we then managing that digital cash when it comes to us? So it's definitely something to not only keep an eye on, but actually do your research on and make sure that, you've got the parameters right alongside the treasury guidelines that you've got in your company. And do those need reviewing? Because are they a little bit out of date now because of the way the world's moved on? So there's a lot to consider on this topic.
Yeah, definitely.
Absolutely. Couldn't agree more. Those are terrific insights. The third story that we shall discuss today is about JPMorgan Chase CEO Jamie Dimon expressing his opposition to the US Federal Reserve's proposed capital regulations, warning such measures could reduce lending and economic growth. I wouldn't be a big buyer of a bank, the head of the largest lender quipped during a financial conference. The proposed changes would apply to banks with more than $100 billion in assets, requiring JPMorgan to hold 30% more in capital than a European lender, Dimon said. To comply, the bank, which bought troubled lender First Republic in March this year, is starting to repurchase stock at lower levels. Is that what they want? Is that good long term? Dimon asked. Paul, from a corporate treasury perspective, would you disagree with the stricter capital rules proposed by US regulators, particularly because the plan to strengthen capital requirements for large banks will likely make lending more expensive and also result in larger banks pulling back from offering certain products and services?
Jamie Dimon's got a point to what he's saying. Obviously, if there's stricter requirements on banks to hold more capital that is less that they can lend out, yeah, it's going to have an impact on rates out there. So I think when you think about our tier one banks, these very large financial institutions here in the U.S., if the Federal Reserve requirements are increasing 30%, is a lot. It's significant. That's definitely going to have an impact. And if you're talking about an economy that's still questioning, hey, are we really going to have a soft landing? Some people out there are expecting that, no, we're not. They're still in that camp of, hey, there's still some indicators out there that aren't good. We're seeing indications that here in the U.S. that inflation is starting to be contained. That's exactly what you want to see. Jobs and wages are still fairly frothy, although wage gains have slowed down quite a bit. We're starting to see some signs that companies are slowing down a little bit on the hiring, but there's still some potential out there that there could be some risks associated with what's going on from an economic perspective. And if you have your major banks having to hold 30% more capital, that's a big number. That is definitely big. And I understand why they're thinking about that in light of some of the bank failures we had. It's a matter of what are the underlying assets that are backing the liabilities. Is JPMorgan Chase taking risks similar to what some of the other banks were that failed? I don't know that because I haven't looked at it, but I'm sure there's some risks associated with their lending and otherwise that they have out there potentially in the books. Is it 30% more? I don't know. That just seems like a big number. So I understand where Jamie's coming from. And I do think it could have an impact on the economy if this requirement comes out. So banks with more than 100 billion in assets, that's quite a few banks. And it'll be a significant portion of total deposits that are out there. So I don't know, 30% it feels like a lot.
Yeah, and like you touched on, Paul, obviously there's always a reaction from a regulator when there's a market event like the banking turmoil and collapses in the springtime. So I suppose on one hand, it's not a surprise to see the Fed mulling a possible increase to the capital requirements, but it wasn't these large banks that were getting into trouble at that time. They were incredibly profitable as a result of what happened at that time. So I think there is also a case with the kind of the pendulum of regulation that when it starts swinging, it can swing too far. And so that could be the case here. I don't know, but additional capital requirements certainly can make it harder for corporates to access lines of liquidity from their banks, depending on the size of the corporation, of course. If you're not one of the huge multinationals, you might not have quite as much sway with your bank in terms of getting that access to liquidity, or you can get it, but it's going to come at a greater cost as the banks try and kind of generate additional revenue because of what they're being put through. So I think that's kind of the concern from the Treasury side. And I always end up saying this, I think, but it's definitely something to monitor. That's my catchphrase, I think, for the podcast.
Yeah, I mean, this is from a lending perspective or access to capital or credit. This puts a big dent in it. This is going to hurt corporations. I think the Federal Reserve really needs to think about this. They need to really make sure that they understand what they're doing in light of everything else that's going on out there. I think it could harm the economy pretty significantly. I'm not sure it's the right step forward.
Paul said he's not sure if it's the right step forward. And Ben, your insightful comments also, I hope, gets people who are listening to this podcast and beyond to think about this topic from a different perspective. Moving forward from stricter capital rules proposed by US regulators, let's shift the conversation to the European Commission cutting its eurozone economic growth forecasts. The European Commission has reduced its eurozone economic growth forecast for 2023 and 2024, with the single currency area weighed down by Germany's poor performance. The European Union's executive arm now expects the German economy to contract by 0.4% this year against its previous forecast of 0.2% growth. In its report, the Commission cited manufacturing weaknesses and said Germany was hit particularly hard by energy price shocks linked to the war in Ukraine. Ben, growth in the Eurozone and the European Union as a whole will continue, but will be lower than predicted earlier this year. And with Germany's economy contracting as well as slowing demand in China, which remains Germany's biggest trading partner, do you think it is time for corporate treasurers with exposure to Eurozone and China to adopt a more cautious or pessimistic stance?
Thanks, Push. Well, it's definitely not trending in a positive direction at the moment, as you alluded to in the introduction there. One of the data points I always look at when you're looking at economic performance is the Purchasing Managers Index, which gives you a kind of a comment on whether certain sectors such as services or manufacturing it's growing or it's contracting. And I had a look at the August composite PMI before we jumped on the podcast today. And for the Eurozone, that fell to 46.7 in August, from 48.6 in July. And anything below 50, like I said, represents a contraction in output. And the composite is both the manufacturing and the services taken together. The trend earlier in the year was that manufacturing was performing really poorly, but the services sector was growing enough to drag the composite PMI up into not a very high, but like a low level growth area. And that's not happening anymore from these statistics. So the services PMI fell below the mark of 50 in August to 47.9, which was its first decline or contraction since December. And the rate of the contraction was its fastest since February 2021. So that's something to note. And the four largest Eurozone economies, Germany, you mentioned, France, Italy, and Spain, all declined in their services output. Ireland was I suppose, a good news story, a bit of an outlier in that it posted a solid increase in services output, albeit slower than before. I was reading comments from the chief economist at Hamburg Commercial Bank, Dr. Cyrus de la Rubia, I hope I pronounced that correctly, who commented that the Eurozone didn't slip into recession in the first part of the year, but the second half will present a greater challenge. For the once stabilizing services sector turned into a drag for the economy, while manufacturing has not bottomed out yet, most probably. So he's sort of pointing to the fact that these numbers, yes, they've gone down, but they could still continue going further. And they carried on saying the disappointing numbers contributed to a downward revision of their GDP forecast, which now stands at minus 0.1% for Q3. So lots of, I suppose, negative outlooks going on around the Eurozone. And of course, for treasurers, that just means that any potential recession or like looming negative, prolonged negative economic performance means that it's a good chance to kind of look at the company's cash flow, monitor that closely, focus on maintaining liquidity and optimizing their cash reserves, short-term investments and credit lines, as well as trying to identify cost-saving opportunities. And often that will be not just within Treasury, but also working with other departments that Treasury is connected to in the flow of cash across the organization. So a few things that corporates can do to future-proof themselves if the Eurozone is sliding into a recession.
Yeah, great points, Ben. We talked about what's going on in Europe before in prior podcasts. I've had my eye on what's going on in Germany in particular. That's the largest economy there in Europe. A contraction in Germany is certainly, or the expected contraction in Germany is not what you want to see. So, if I'm a treasurer in the European zone in particular, or if I'm doing business in Europe, I need to think about what that means. Treasurers, both here in the U.S. and in Europe, if you haven't been doing it, you need to take a look at your capital structure today. and what you might need to do to shore things up now before access to capital really dries up further. And we've seen some challenges for some organizations, especially smaller companies, to gain access to capital, both in Europe and the US, as rates have risen. So I think from a treasury standpoint, that next tier of companies, they need to be looking at their capital closely.
That's terrific advice, Paul and Ben. And finally, what is your choice for the biggest or most important story of the past week and why? Paul, would it be one of the 4 stories we discussed, or would it be some other news item for you?
We're getting closer and closer to a point where I think central bank digital currencies are going to get more headline news. So I think there's going to be a continued trend to see what happens along there. The markets are out there. They're creating payment rails utilizing stablecoins in local currencies. We're taking a script from what China's been doing in essence, and there's demand for that. I think we're going to continue to see that demand grow both from consumer and a corporate side, hitting a point where if central banks in other countries outside Asia aren't making those moves, we're going to see an increased movement by the markets to provide something in the interim until the central banks can get to where they're comfortable with central bank digital coin. So this isn't something we haven't talked about before, but I just think we're going to see more and more headline news about this because it's relevant and people need to get comfortable with that we're moving away from paper and coin currency to more digital. And we've been there in many respects for quite some time, but things are rapidly changing and we're going to have to change along with it.
For me, it was just, some of these economic data releases. I've been keeping an eye on. The US inflation recently came out, and the August annual headline CPI inflation rose 3.7%, beating consensus expectations